We're now going to work through the packet. I'm sometimes asked if I can't just supply the solutions to the chapters, and the answer to that is no, because of learning. You learn better if you actually pick up your packet and start writing in the packet the notes or start working through the problems. Some students don't even work through the packet. They keep the packet blank and they get out a separate piece of paper and work the problems on it so that when it's time for their exams, they have the blank in front of them and then they can just go to it and work through it. You'll also get a chance to work through some of these problems again when you go through Learn Smart or when you work on the quiz at the end, because I try to include those as well. And I hopefully put in some algorithmic problems so that you aren't replicating numbers and just remembering numbers. The first question here has to do with liabilities, and they ask you for a definition of what a liability is. So we're on about page 70 of your packet. We have ways back because the first part of your packet is probably review materials. And I said it's like the ghosts in the Scrooge. We have past, we have present, we have future, and you should remember that there has to be something that happened in the past, and that today, if we looked at it, there's an obligation implying that we have some sort of a commitment, or we have some sort of a legal binding sort of a thing happening. And then we also notice that in the future we're going to have to make sacrifices. We anticipate these sacrifices. The sacrifices themselves do not have to be in cash. If it's cash, we usually call it a payable. So that's just your little review there of those concepts that are very important. In the next exercise, we are asked to record the amount for vacation pay, and this is the amount for vacation pay given the situation where total wages paid to employee was $404,000, but they wrongfully included in that 404,000, 4,000 for vacations taken. Now the reason why you don't put the 4,000 in there as an expense because the 4,000 includes the using up of a liability that you would have recorded previously. Perhaps it would be helpful if I go through this and read to you what the problem is. The employees earn vacation time at the rate of 1 hour per 40-hour work period. And the vacation pay vests. The terminology for vests means that the employee is owed. So when you see the word vest, it means employee is owed. We have this again when we get to our pensions chapter. So it means the liability is created. I mean, we have a commitment. That's what it means by vesting. So vacation pay vest means we have a liability as a company to let the employee take vacation. That means they don't come into work. But what else does it mean? It means they continue to be paid. So they are paid that are not producing for us, and therefore we aren't going to call that when they take their pay, when they don't come into work, we're not going to call that an expense then. We are going to call it an expense as it accrues. So this is an accrual situation. We are accruing the expense, and although you see the solution here on the screen, they call it wage expense, you can call it vacation pay expense. That's fine. It becomes a part of salary expense. It becomes that part when we show it on our financials, but it's vacation pay expense, and the liability which is created is a liability which relates to them taking it later in the future. So we are going to call it a debit to an expense, a credit to a liability, and it's going to be recorded as an accrual, a type of accrual, which is vacation pays. This is our objective 2 that we are addressing now too. So I'd say then that really the total wages which we paid was $400,000 for the year. That's their basic wages. And they also we need to recognize at that point then that their basic wages, 400,000, if they are going to earn it at the rate of 1 hour per every 40, we could go through the calculation and we could say what is their average pay, and we could calculate that, and then we could say that they make so much per hour and they're owed so many vacation hours, and then we multiply. The way they chose to do it in this problem was to say we have a total value of our wages for that whole year of 400,000, and 1/40th of it is the amount which we should earn in vacation pay for those employees in this year. So if they should have $10,000 in vacation pay and they already took 4,000 and they did it improperly in their journal entries, then we should have a balance of 6,000 to carry over. So even though this journal entry in front of you is really crazy, and it's crazy because they did the journal entry wrong, and what they're doing is saying in here, prepare the appropriate journal entry for vacations earned but not taken. What they're saying in this problem is fix it. Fix the problem, because as of right now, we have wage expense of 4,000, right, for the vacations taken. But the total amount of vacation expense we should record is 10,000, which is calculated, again, 1/40th of the 400,000. So they're doing an entry. I wouldn't call it an adjusting entry. I would actually call it a correcting entry, because they recorded things improperly, and they have to put an extra 6,000 in their vacation pay expense and an extra 6,000 in their vacation liability. So if they'd recorded it right, what would they do? They would record a debit to wage expense in this calculation for 10,000 and a credit to the liability of 10,000. And then during the period of time, this particular year, if employees take their vacations, then you are going to take it out of the liability, and apparently they took 4,000, so we would be debiting the liability for 4,000, and that would be the journal entry that we would do. Okay, so the correct way to handle this whole scenario and this whole paragraph, assuming they had recorded it right in the beginning and put wage expense at 400,000 and not 404,000, would be to record a wage expense of 10,000 and a liability, a wage expense vacation pay 10,000, liability credit for 10,000. And then when they take, during the year they actually took 4,000, you would be debiting that same liability for the 4,000. That would be the appropriate way to handle it. That's what I want you to know, and that's what I want you to understand. Okay, on exercise 13.5, we have a situation where Popular Fabricators Corporation is granting 2 weeks pay, but they have to take it all in the next year. So in this one, we have the average pay of $900 a week. We have 700 vacation weeks. So we know that the 900 times the 700 gets us 630,000. As I said before on that previous problem, they didn't use average pay on it. They said the total, and then you took the 1 over, I believe it was 40, to get to your number. In this one, they know what the average pay is per employee, and they know the number of vacation hours they should have, and so they record it. And this again should, be easy or intuitive to you because you're going to record this. They don't have a date in this problem, but you would record this at December 31st, 2018. Now, they don't get to take it though until the next period of time. So you accumulate that, and then at the end of the year you got a year to take it. So this also thing to think about here is this particular one is going to go away in how long? A year. So I'm going to say it's a current accrued liability. Now the second part of it says what happens if a little trick in this intermediate level stuff is they always give us a little interesting thing that happens. So we thought that the average pay was $900 an hour. But now it turns out that the average pay should be actually more than that. Our actual pay should be 5% more. And as always, they make it a little more complicated than it needs to be in our solution. Because they're saying, what happens then in the next period of time? If in the next period of time we realize that the amount which we accrued was wrong. If you have an accrual for a liability and you realize in the next period of time that you have accrued it improperly, and this is not the same thing as in the PowerPoints where we had contingencies and we had more information. This is not a contingency. This is an accrual. And in this case, we have more information and we realize, realize meaning we know, okay? We know now that we should have recorded that not at 630,000, but we should have recorded it at 661,500. That's what we should have recorded it at, because we should have recorded it at 630,000 times 1.05, so 5% more. Okay, so 661,500 should have been our initial recording. What do? Well, they make our life a little complicated in this journal entry. What do I want you to know? All I want you to know is that in the next period of time, when they're actually going to take those absences, they're going to take their vacations, so the liability is going to go away. We need to increase our vacation expense by 31,500, and we need to pay them in the additional amount of 31,500. Okay? So the journal entry that they give us here in requirement 2 is more complicated than it needs to be. What would we do? We would increase, we would record a vacation pay expense, we would record a vacation pay liability for an additional 31,500, and then we would turn around and we would debit that liability for 661,500, and we would get rid of it. So we would get rid of that additional 31,500 that we're recording in the second year, and we would get rid of that initial vacation pay expense which we had under requirement 1. So you need to get rid of both of them. I don't particularly like the way they did this problem because they say wage expense, and included in the wage expense is that extra 5% vacation pay. You can see it here. And technically, we have two expenses that we're going to record in requirement 2. We are going to record the basic 31 million in wage expense, wages payable, right? And then we are also going to record a 31,500 for vacation pay expense, that additional 5%, and then we're going to record a credit there to liability for compensated future absences. And then the third journal entry is going to get rid of both the 661,500, which is the total amount of vacation pay, and it's also going to get rid of the amount which we owe for our wages, which was the 31 million. Okay. On to another problem. And the next problem, it's gift cards. So before I get into this and start really talking about gift cards here, I want to discuss gift cards. So when we have a gift card, what we need to do with a gift card is we need to call it deferred revenue. And you know from your previous studies, deferred revenue is merely a liability that will become revenue at some point in the future. So we have a couple of concepts with deferrals and accruals. You know that when you accrue an expense, you record an expense, and the expense then creates a liability, right? And then you also have an issue when you have an item that is a liability and it's called a deferred revenue, and it turns into revenue. So this is another kind of series of journal entries that you do. You create the deferred revenue, which is really a liability, and then you make it become revenue by debiting that deferred revenue and calling it revenue. So the problem here, you probably should be writing out some sort of a chart here, and what you'll do is you'll figure out that there's a gift card program that starts in January, and they sold 10,000 in January, they sold 15,000 in February, and 16,000 in March. So what they would be doing then is they would be debiting cash in January for 10,000 and crediting deferred revenue, and with a caption by it. Very important that you do this. Caption is January gift cards. And that would be 10,000. Then in February, you're going to do the same sort of journal entry, except you're going to change your journal entry caption to deferred revenue gift cards for February. So you're going to be debiting cash coming in, 15,000, and you're going to be crediting your deferred gift cards with a caption February for 15,000. And then in March, you'll be doing another journal entry. So hope you're writing these things down. You will have a debit to cash, and you will credit deferred revenue gift cards March. Now those three liability accounts, deferred gift cards January, deferred gift cards February, and deferred gift cards March, have to be kept separate. They have to be kept separate because you have a different expectation as to whether the gift cards will be used or not based on how long they're on your books. So let's explain this. If I give you a gift, which I don't think I would do that because it'd probably be improper, right? You probably want me to give you a gift card, but it'd be improper. If I were to give you a gift card, and I gave you a gift card, say for Christmas, and you had it, if you did not spend that gift card by July, the expectation might be that they've probably forgot about it or lost it, right? But if I give you a gift card and you use it in January, that's a different situation. That means you have not lost it or set it aside or forgotten about it. And so the thinking here is if I have gift cards and I'm a retailer and I have gift cards that are on my books, not used by customers, not the customer hasn't come in and used the gift cards. So when they use their gift cards, then that deferred revenue goes away and it becomes revenue. So if I have deferred revenue on my books that exist for sales of gift cards I made in January and now 3 years later, what's the probability that the customers will come in and use the gift cards 3 years later? Very low. So when you look at your gift card accounts, you need to be able to look at them and say, don't think they're going to come in and use them. I think they're going to come and use a certain percentage. And so it gets to a point when you realize that it's highly unlikely that the gift card will be used. You will call all of that gift card, that deferred revenue, you will call all of it revenue. Okay. And this is what is called breakage. Okay? It's called breakage. So in the solution, it says gift card breakage when we get to the solution. So we have these three groups, and they are originally recorded in January, February, and March, and they're deferred revenue amounts. And when we do our financials, of course, you would put them all together and call it one liability, but for now, we're going to have to keep them separate. So in March, after March, they decided we're not going to do any more of these gift cards. These gift cards are ridiculous, so it's not worth our time. We're not going to do it. So in March, they stopped. So you only have 3 buckets, I'm going to call them buckets, of gift cards for this year. During 2018, gift card redemptions were 6,000 of the January, 4,500 of the February, and 4,000 for the March. So what happens? Well, those gift cards go away and they become revenue. And since we're a retailer, we would call it sales. Now here's an interesting thing I want you to understand. When you have sales, what's the expense account for a retailer that goes along with a sale? Yes, cost of goods sold. So if a customer comes in with a gift card and uses it, the financial statement or income statement effect for the retailer is they record a sale just as if the customer had bought with cash or a credit card, and they record a cost of goods sold. Now, what happens if the customer forgets about it, completely forgets about it? Well, if the customer forgets about the gift card or loses a gift card, then that retailer doesn't have to record cost of goods sold because there's no merchandise given up, right? They get to take it all to revenue. So that's the deal. So you ever wonder why they make the gift cards so small? Because they want you to lose it. If you lose it, they get to take the whole thing to revenue. And if you don't lose it and you use it, then they have to record cost of goods sold, which impacts their financial statements in a lesser way. They would rather take all of that, say in January, 10,000. They'd rather take all that, wouldn't they, to revenue and not have to record any cost of goods sold? Yeah, wouldn't that be ideal? But if the customer comes in and actually uses up part of those gift cards, or they don't lose them all, then they're going to have to record some cost of goods sold. So the amount of the net income effect from gift cards depends upon whether the customer uses a gift card or they lose the gift card. If they lose the gift card, the retailer makes more than if they don't. That's a net income. Now your textbook, we covered this and we said in some states the forfeited go to states for revenue and all that. Well, I'm going to assume that that doesn't happen here, and that's how I'm doing the journal entries. So I'll just tell you that right up front. That's the way I'm doing the journal entries. So then they have another thing here that says they assume that if you go 10 months after a sale, then the customer's not going to be using it. Okay? So if they have this assumption, that means anything that's out there in a deferred revenue account 10 months after the date at which the gift card was sold, they'll take it all to revenue because they figure it's been lost. And that is the term breakage. Okay? So, this question here says, how much revenue will Circuit Town recognize? And I think it's interesting that it's called Circuit Town because I actually work for a retailer, and one of our entities was called Circuit City. So I'm thinking they're using that one in this problem, which is kind of cool. Okay, but Circuit Town, how much revenue would they recognize during the year? Okay, so they have to go out 10. And if you start in January and you go 10, you're getting around 11, right? And so by November and into December, and we're considering in all these problems December 31st year end, then all of that total amount, which is 10,000, should be going to revenue. And I'll explain. Part of it goes, as it says here, because the 6,000 was redeemed. The customer came in and used the gift card. But the other assumption we have is that if they don't use the gift card, they lose it, and we assume they are going to lose them after 10 months, then we get to still take it to revenue. Now, which would you rather have again? The 6,000 when they redeem it, or would you rather have the 4,000 because they lose it? I would rather have the 4,000 because they lose it, because then I don't have to record cost of goods sold. There's no merchandise going out the door with that customer, so I'd rather have the 6,000 in terms of financial statements. But the entire 10,000 is handled that way. We're going on to requirement 2. Do the entries to record the sale. Seems like in a back way of doing it, I would have probably done the journal entries first. In fact, I did cover these with you. Notice they forgot the caption here. They should have January by that. Okay? The other thing I would say is, I gave you this earlier and I said debit to cash. Do you have to buy gift cards with cash? No. When the gift cards are bought, they can be paid with credit cards. It doesn't have to be a cash transaction that the retailer is handling here. Well, that gets it on the books. And then again, with the 6,000, when they are actually redeemed, you need to, at this point, say deferred gift card revenue January by it. So you keep all these buckets straight. So then you'd say, well, after these are redeemed, what balance would you have? And you'd say, well, there's 10,000 created as liability, there's 6,000 which goes away when the customer comes in with the gift card, leaves us with 4,000 on our books. And if it's after 10 months, you are then going to do the next thing, which is take the additional amount and call it revenue. So what's missing from this that makes it look like you're in the same financial situation with redemption and expiration is that when you have redemption, you got to record the debit to cost of goods sold and the credit to inventory. And when they expire, you don't do that because there's no inventory leaving. Okay, so that's the difference. You could do this also in T accounts. Some students like the T account approach where you create the credit, the T on the right for 10,000 and then the two debits on the left for the 6 and the 4. It just, whatever makes you happy there. The next question is, how much revenue will they recognize with respect to the March during 2018? Well, they had March, they had 16,000 in sales, so we're going to record the 16,000 in sales. The March will not will not go away though until again 10 months. So if you go out 10 months for March, you see that you're getting further along than you were with the January, because you're 2 months on the calendar extended. So when you do that into March, you realize that those really don't go away until into January. So in Marches, you have 16,000 sold, and you have 4,000 that are redeemed in the year, which means you have 12,000. And these 12,000 counting out from March, going 10, yeah, 3 and 10 is 13, which is December would be 12, so we're into January. So you cannot take that additional remaining 12,000 into revenue unless it gets redeemed, or you get to the date of January when it's considered to expire, and their word for that is breakage. And if you do this and you do the T accounts and you go through T accounts on all of this stuff and actually did your journal entries, you would find that when you get to the end of the fiscal year, which happens to be 12/31/2018, you do your financials, which is in requirement 4. They would say, what liability to deferred revenue, and this is not a revenue, they're asking a revenue question, they're asking a liability question, would you have? And the only thing you would have at that point would be the ones which would be considered to break in January, and that's from your bucket in March. So I encourage you to work through the problem on your own, and if you don't understand, then come back and start make note of where we are, and come back and just watch the video again and work through it and listen to the explanations. Now, next learning objective takes us to notes. So what I'd like to tell you now is, when you work through your packet, you will notice that these problems and exercises relate back to the same ones that are in your textbook, and also they relate back to your smart book, and they also relate back to your quiz work that you're going to have at the end. And the learning objectives are very broadly stated, but when you get into the problems, you are putting numbers in concepts. So this semester, we start out and we discuss concepts, and we get into a little bit of numbers in the PowerPoint lecture. Then when we start working on our problems, we kind of give you examples of the concepts. And one good way to know that you understand what we are working on is that you can go back and forth in between the problems we worked and the concepts we discussed. So when you're reading over your outline at the very end of a module, you should say, I remember that problem. That's why we did it that way, because of this concept. And you should be able in your mind to have a kind of a fluidity. If you don't have the fluidity, then it's a good indication that you really don't understand it enough. You need to continue working with it, continue reading. If you need to read your ebook, read the ebook. You need to continue working on it so that the concept and then the numbers, which we're working on now, flow together. That's my advice. Students that get A's in my class, they have no problem with that, and that's what helps them to do well. Oh well, here we are. This is on in the Learning Objective 3 on notes, brief exercise 13.2. We have a non-interest bearing note with a accrued interest. And that is because even though it says non-interest, we know there is always interest. There is always interest. It's just that the interest is not paid. We also know that non-interest bearing means that the stated amount is zero. Stated interest on that legal document is zero. It says zero interest, but we know according to GAAP, we have to imply, and we call that implicit interest. We have to put the interest in there somehow. So in this case, they're borrowing 60 million. If you borrow 60 million and it's non-interest bearing, you have to take the 60 million. You have to do the first thing you do is you split the 60 into interest and non-interest. Okay? And the shortcut method says you should take the amount borrowed times the interest rate, and in these problems they don't call it interest rate, they call it discount rate, times the number of months over the total months. And I'm going to say that this way in this chapter because it's always going to be less than a year if it's going to be current. Okay, current. All right, and I won't give you exactly a year because that gets confusing for students. If I give you exactly a year, someone says, well, is that current? Is that non-current? It's right on the line. I'm not going to do that to you folks. Okay, so we're talking about months, not 12 months, someone less. Okay, well, this is 9 months. So you're going to take 60 million, pardon me, times 9 over 12 times 12%. And if you want to shortcut that, 9/12 times 12 would be 9. So 60 million times 9%. And when I do that, I get 5.4 million for interest. If 5.4 million is interest and the total is 60, then the difference, which is 54.6 million, must be the actual loaned amount. That is the actual amount of cash they're going to be given because the lender is going to subtract the interest up front and give them less cash. That's the way the non-interest works. So in calculating it, you get something like this. Now, unfortunately, this number right here should be obviously over here as a credit. We should have a total of 60 million as a credit. Now, what happens at the end? At the end of the 9 months, there's not going to be any interest paid. There is no interest paid because stated is zero, okay? And it's non-interest bearing. However, at the end of the 9 months, we are going to have to pay the total 60 million. They gave us only 54.6 million, but we got to pay 60 million in the end. So somehow, in between now and 9 months, I need to really make a return so that I can come up with the difference between the 54.6 they give me now and the 60 I got to pay them at the end, just looking at it from a business perspective. I'm going to have to pay 60 at the end. Well, what happens to the 5.4? This is amortization of discount, and recall amortization of discount is a debit to expense, and we call it interest expense, and a credit to discount. Now, this business here says prepare the journal entry for the note at December 31st. It's October. It's October. And here we get into it again. Is it the end of October or the beginning of October? It started on October 1st, not October 31st. So if you need to count it on your hands, count it on your hands, your fingers, October, November, December. If you need to write O-N-D and then say, oh, there's 3 months, then do so. The point here is it started October 1st and it ends December 31st. And you notice that October 1st is really the same thing as what? September 30th. And if you did it that way, you would realize September 30th to December 31st is 3 months. So some people do it that way, and that's the way they also keep it straight in their head. It's 3 months, and again, you can cancel this 12% and the 12 in the denominator out. You see it's 3% of 60 million, which is 1.8. This is not the end of this note, right? We are going to then get rid of the rest of that interest discount, recording interest expense in the next time period, which will be the remaining 6 months of it, to get rid of it. And since it's 1.8 in interest expense for 3 months, for the next time period, the next year, you've got the other 6 months, which should be double the amount. So that would be 3.6 in the next year. The 3.6 interest expense in the next year will be recorded the same way as this journal entry for the 1.8. Again, there is no interest payable account. No interest payable because we're not paying interest. Well, I beat that one to death, didn't I? Let's go on to BE 13.3, determining accrued interest. They want to do simple accrued interest, and this is not a non-interest, but this is a stated interest one, because in it, you're looking at your packet, you see Orca Lab issued 100,000, 12%, 8-month note. So this is not non-interest bearing, but it is interest payable, and the next sentence actually tells you that. So when you do your accruals for this, it's not interest expense discount. It is going to be in these calculations, interest expense, interest payable. So doing the journal entries, interest expense, interest payable. And to do these, they're going to change our fiscal year end. And I told you in here, your assumption is that it's going to be December 31st. So the first one would be straight December 31st. Again, this problem starts July 1st. July 1st, you should think of that as June 30th. And the difference between June 30th and December 31st is 6 months. So simple math gets you 6,000. If, however, it was September 30th, again, you would start June 30th to September 30th. And if you wrote June 30th numerically, you would see it's 630. And if you wrote September 30th, you'd write 930, right? And that's 3 months. So there you get your 3,000. Again, these journal entries would have you recording your interest expense and interest payable, not discount, interest payable, because you're actually paying it. In Learning Objective 4, we begin discussing what we do when we have contingencies. And for this, I guess I have my break a little strange here. We are going here and we are talking about what they're calling contingencies. As I said before, I object strongly to calling a warranty expense or warranties as contingencies. They more properly should be called accrued liabilities. Okay, not contingencies, accrued liabilities. Classical Products carries a 1-year warranty. So for any time they make a sale in 1 year, they're going to have a liability on those products that extends for a year. Similar to what we did with the gift cards, you're going to have to keep track of dates. So when you put this amount in this estimated warranty liability for these accruals, you will need to be sure and say what particular time period it relates to, and because your liabilities are going to relate to a time period, and after a year you get to take the liability away. How about that? And you know, if you take a liability away, that's a rather positive thing, isn't it? And the fact that you don't have the liability anymore, and the fact that you have a credit, which usually shows up on your income statement. So that's a wonderful thing. This is another convoluted problem because 4% of sales should be going into this warranty cost account. And in 2018, then the total amount they should have recorded should have been 2%, 4% of 2 million. Instead, they already put 30,800 in it. So this is more like a correction. I don't want to call it adjustment because I think they recorded it wrong initially. They should have done warranty expense, estimated warranty liability, and it should also have the caption 2018 sales, and they should have done that for the 80,000. Okay, the 4% of 2 million. So because they already put 30,800 in it, they're going to do it for the 49,200. When you have your exams in here, what am I going to ask you? Am I going to give you some crazy thing like this? And I'm going to try not to. I'm going to try very hard to say, what's the journal entry that we need to do associated with these sales? You know, for warranty, what's the journal entry? What's the accrual? You're going to say warranty expense 80,000, estimated warranty liability 80,000. You're going to have a caption that says it relates to 2018. 2. Just want to kill the graduate student who came up with these problems or whoever wrote these problems, because in 2, they are saying that 2% of credit sales will prove uncollectible. I want to say, is this a contingency? What did I say about contingencies? Contingencies are liabilities. Is bad debt expense or the allowance for uncollectible accounts a liability? No, they're not liabilities. Allowance account is a contra accounts receivable account. Bad debt expense is not something that's associated with a contingency because it's something the business would normally incur. We expect there to be some of our accounts receivable accounts to be from deadbeat people who are not going to pay us, right? We expect it. So I don't like to. I don't like to for 2 reasons. If you're recording it, you record it this way. I'm going to ask you about that some other place. Probably not. You need to understand what a contingency is. Number 2 is not a contingency. This is a journal entry. Number 3, I'll repeat it to you. The state of Tennessee filed lawsuit against Classical seeking penalties for violation of Clean Air Acts. However, Classical reached a settlement to pay 1.5. Okay, and we're supposed to talk about this and what we would do with this thing. This is clearly a loss contingency. And what we would do would be, if we knew the amount on December 31st, and again we're going to the assumption that's the fiscal year end, we would do a journal entry and we would record loss and we would record a liability for lawsuit. And we would record it to the best of our ability and the amount that our legal team told us that we should record. In this case, on January 23rd, which is probably before financials, remember I said they're usually done in March, they found out that the amount they're going to pay is 1.5. So basically, what will the financials show? Did they have the contingency at December 31st? Yes, they had the contingency at December 31st. Did they know the amount? We don't know. What should the financials show? Because we have the information before the financials are issued, we're going to show 1.5 in our financials. Now, this journal entry I'm going to show you assumes that they did it all in one giant journal entry, okay? I'm just saying, probably what happened is they had a number December 31st, they recorded it. Then on January 23rd, they get an updated number, so they record an additional amount. It could be a little more, it could be the opposite direction, reversing out what they originally did on December 31st. I don't know. But all I know is when they do their financials, they should show a loss in their income statement of 1.5, and they should show a liability of 1.5. This is a material liability, I would assume. If it is a material liability, they need to disclose. They are going to have to do a disclosure note. So this is truly a loss contingency situation. Now, on 4, classical is a plaintiff against a supplier. So classical is suing someone, and they're a plaintiff. They're not being sued, they're suing someone. And they believe that they are going to win, and they're going to get 2.5 million. Yeah, this is a type of contingency, I guess, except is it a liability? And your answer is no, it's not a liability. It is actually a receivable or a type of asset because we expect to be paid. Okay? We expect to be awarded 2.5 million. What do you do? What do you do? Well, you don't get to record gains. That would be a gain. You just don't get to do it. We only get to recognize it when it's realized. What's the word realized mean? Realized means you got it. Okay? You got the cash. So if it's the same as cash, they've made a deposit in a bank account someplace of the 2.5 million, then of course you get to record it, and you get to record it in your books. But until the point where you actually have the cash, you can't do it. You contrast that to the one above. In the one above, we haven't paid the cash yet. So there's no cash transaction yet, but we anticipate it. So we have a liability. Liabilities, you think it probable, you're going to have to make a sacrifice. And this is called a gain. And gains, you don't get to record it. So you have a conservatism thing in accounting which says if you think something bad's going to happen, you got to record the liability. If you think something good is going to happen, you don't get to record it. Isn't that sad? But you don't. You have to wait till it actually happens. In November 2018, we're up to 5. They became aware of design flaw in an industrial saw. Oh my God! The industrial saw is going to kill us, I guess. Repair is unavoidable, and it likely cost the company $500,000. Oh my word! Well, of course, that's going to be a liability, and you're going to record it. And the other thing is, when you do this, you're gonna put a note in there. This disclosure note is a note to the financial statements, and the reason why you have to do a disclosure note on this particular one, and most of these contingencies you do a disclosure note on, is because it could actually be greater. If you think about this is an industrial saw. I don't know, maybe somebody's going to die. You can see that could be millions, right? Okay, on 6 we have offering $25 cash rebates on a jigsaw. They mail in a proof of purchase from the package, and our experience suggests, so here we are doing estimates, 60% of the rebates will be claimed, and the total rebates were $105,000. They were recorded as promotional expense when paid. Okay, so what you should probably do is every time you have a sale and you expect it to be a portion of those to be given back to the customer in terms of a rebate, you should be recording a promotional expense or some sort of an expense there, and you should be recording a liability. Now, most of you, or some of you, each year in my classes, there's a student that goes to Menards, and they know that if they shop at Menards, they will later on get this little postcard like thing in the mail, and they can take the postcard thing into Menards and use it like cash, use it toward the next purchase. So what Menards is doing is a very similar thing. They are, every time they are making a sale during their promotional period, they are assuming that some individuals will actually take the time to fill in the documents so that they get the rebate. And then once they get the little postcard, and again, it's just like the gift cards, what do? We make it small so the customer is going to lose it, right? So yeah, we get those and we get them in. The customer gets this in, and the customer then takes it back and uses it like cash. And it's the same thing as really a kind of a gift card situation. You create this liability. Now, the difference between it and a gift card is with a gift card, you're going to assume the whole thing is going to be turned over to revenue at some point in the future. Instead, with this one, they are taking it directly to an expense. Now, if they had recorded this properly, they would have recorded 60% times 25 times 10,000, and that would have been their promotional expense. And unlike the gift card situation, which is like Menards, it's not going to be called a deferred situation. It's just going to be a direct expense because they're going to be giving them cash. These are actually going to be cash payments that are going to be made and mailed. At Menards, we don't do it. The Menards is more like a gift card situation. It is a recognition of a deferred revenue account. Okay, so the way this properly should have been done would have been 60% times 25 times 10,000, or I believe that is what? 155,000, I believe. They should have had 155,000 in promotional expense and estimated liability. Again, with this, let's keep track of the amount we record for a particular time period, because we need to know and need to have an idea of how many of those are actually then taken, how many of the rebates are actually used or applied for. Really is a coupon. And here it says, if the rebate was offered as a part of a sales transaction, it would be accounted as a variable consideration. It said in that case, rather than debiting expense, the sale would be reduced and a liability for the estimated amount will be paid into the future. Okay, let us go up here to talk about what a loss contingency is. A loss contingency, as I said previously, has to be a liability. So I'm going to tell you, first thing is a liability. And then I'm going to say, is it an accrued expense? Because if it's an accrued expense, it's not the same. So your textbook is going to say a possible repair to a product under warranty is a loss contingency. So I'm going to say no, X that one out. That's an accrued liability. An uncollectible receivable, is that a liability? No. And so the only one here in this solution that it is proper is going to be 3, defendant in a lawsuit. So the textbook sometimes gets things a little wrong. They did. Describe the 3 categories of likelihood. All right, this is where I get into my probable and my reasonably possible and also my remote. Probable means it's likely to occur. This, I said, is a betting event. You would bet that it's going to happen. Storm clouds are gathering, right? Reasonably possible means it's a little more likely than remote, but it's still not so likely to happen. And then remote is the confirming event will occur is very slight. Hurricanes hitting us, slight. More Oklahoma being hit by a tornado, it's looking like it's somewhere in between probable and reasonably possible, isn't it? So it has to do with the circumstances. You cannot just flat out say needs to be recorded or doesn't. It's an expert opinion. Under what circumstances should a loss contingency be accrued? Okay, they're mixing their kind of metaphors here, because I said accrued expenses and contingencies should not be used in the same sentence. So when should we record? When should we record? The proper way of putting it is this: when should we record a loss contingency? Two things. It has to be a liability, right? And it says that in this explanation. And it has to be probable. And you cannot do a journal entry unless you have what? Unless you have an amount. The food for thought one says, Target expects 5% of merchandise will be returned. How should it be handled in the current year? Can you think of a way which they account for sales return? If it doesn't account for return, what accounts may be overstated? And what should they do about in the current year about returns for future year sales? Well, the first part of it is what all retailers have to do is they have to reduce both sales and cost of goods sold for the fact that certain amounts of their sales will actually be returned. And if they are returned, then in effect they really have not had a sale. So that's something to think about. And on the last one, on B, if there's no past transaction, which is that original sale, then they don't get to do anything. Okay? They just can't do anything at all there.